3 days. That's how long the global economy can function if trust disappears. Not 3 years, not 3 months. 3 days. After that, ships stop unloading, banks stop wiring, payroll freezes, supermarket shelves begin to thin out, not because the world ran out of food or fuel, but because the system that moves them quietly seized up. The global economy doesn't run on money alone. It runs on belief. And the structure holding it together is far more fragile than most people realize. Right now, we're living through a period of surface calm. Markets fluctuate, headlines rotate, central bankers hold press conferences with carefully chosen words. But underneath that noise is an invisible framework connecting governments, banks, corporations, and entire nations through a web of debt collateral and short-term funding. It looks solid. It isn't. To understand why, we have to start with a simple question. How does money actually move across the global system? Not the cash in your wallet. The real money, the institutional money, the trillions that shift between countries every single day. Here's the uncomfortable truth. Most global trade isn't settled with stacks of currency. It's financed through credit, short-term promises backed by longer-term promises. Imagine a company in Germany buying oil from Saudi Arabia. The oil ships today. Payment might not settle for 30, 60, even 90 days. In between sits a bank. That bank extends credit, often in dollars. Even if neither country is American, that detail matters. The modern global economy runs on the U.S. dollar. Roughly 80 to 90% of global trade finance is invoiced in dollars. Corporations outside the United States have borrowed trillions in dollar-denominated debt, not because they love America, but because the dollar market is deep, liquid, and trusted. So now we have a system where foreign banks need dollars to finance trade. Corporations need dollars to service debt. Governments hold dollar reserves to stabilize their currencies. Where do those dollars come from? Not from pallets of cash shipped overseas. They come from the global banking system. Specifically, through short-term lending markets like the repo market and the Eurodollar system. These are markets most people never hear about, but they function like the circulatory system of global finance. In the repo market, institutions borrow cash overnight by pledging high-quality collateral, usually government bonds. It sounds technical. It's actually simple. I'll give you this treasury bond. You give me cash. Tomorrow, I'll buy it back slightly more expensive. That tiny price difference is the interest rate. Now multiply that transaction by trillions of dollars, happening daily across time zones. This is how banks fund themselves. This is how liquidity moves. This is how trade keeps flowing. But here's the catch. The entire system depends on collateral being trusted. If government bonds are viewed as safe, everything hums along. If their safety is questioned, even slightly, the machine stutters. We've seen this before. In 2008, it wasn't just bad mortgages that caused the crisis. It was a freezing of short-term funding markets. Banks stopped trusting each other's collateral. Repo markets tightened. Liquidity vanished. Institutions that looked strong on paper suddenly couldn't roll over short-term funding. Lehman Brothers didn't collapse because it had zero assets. It collapsed because it ran out of trust. And trust in this system is measured in hours. Fast forward to today. Global debt, public and private combined, has surpassed $300 trillion. That's more than 3 times global GDP. Governments issue bonds to finance deficits. Banks hold those bonds as assets. They use those bonds as collateral to borrow more money. That borrowed money finances everything from corporate expansion to government spending to asset purchases. It's a layered structure. Debt backing debt backing debt. As long as interest rates stay low and growth remains steady, the math works. But when rates rise quickly, as they did recently, something subtle happens. Bond prices fall. And when bond prices fall, the value of collateral declines, which means institutions have to either post more collateral or reduce borrowing. That process is called deleveraging. It sounds clinical. In reality, it's a scramble. Sell assets, raise cash, shrink balance sheets. If too many players do this at once, liquidity dries up. In 2019, something strange happened. The U.S. repo market, the most stable funding market in the world, suddenly spiked. Overnight lending rates jumped dramatically. The Federal Reserve had to intervene, injecting tens of billions of dollars to calm it down. This wasn't during a recession. It wasn't during a pandemic. It was during a normal year. That moment was a warning, a reminder that even the plumbing of the financial system can clog unexpectedly. Then 2020 arrived. When the pandemic hit, markets didn't just fall. They malfunctioned. Even U.S. Treasury markets, the safest, most liquid markets on Earth, experienced severe stress. Buyers disappeared. Volatility surged. The Federal Reserve stepped in again, not gradually, but overwhelmingly. Trillions in liquidity programs, emergency facilities, swap lines extended to foreign central banks so they could access dollars. Swap lines are another piece of this fragile structure. When foreign banks run short of dollars, their central banks can borrow dollars from the Federal Reserve in exchange for their own currency, temporarily. It's a lifeline. Without it, global dollar shortages could trigger cascading defaults. Notice what this means. The stability of the global economy rests heavily on one institution's ability and willingness to provide liquidity, the U.S. Central Bank. That's a lot of weight for one pillar. Now add another layer. Banks today are more regulated than in 2008. They hold more capital. That sounds reassuring. But tighter regulations also mean banks are less willing to absorb shocks in bond markets. When volatility spikes, fewer institutions step in to make markets. Liquidity can evaporate faster. At the same time, non-bank financial institutions, hedge funds, private equity, shadow lenders have grown massively. They rely heavily on short-term funding, but operate outside traditional banking backstops. So we have more debt, more leverage, more reliance on short-term funding, and a larger share of that activity happening in less transparent corners. The structure still stands, but it's more complex. And complexity often hides fragility. There's also the political layer. Governments around the world are running persistent deficits. Aging populations increase spending on healthcare and pensions. Defense budgets are rising. Infrastructure needs are massive. Issuing debt is the easiest solution. As long as investors buy government bonds at reasonable rates, deficits feel manageable. But if investors demand higher yields, either due to inflation fears or fiscal concerns, interest costs climb. Governments then issue more debt to pay interest on existing debt. It becomes a loop. Again, it works until confidence wavers. And confidence is not a constant. It's a mood. Popular narratives often frame economic risk around stock market crashes. But stocks are just a visible surface. The deeper risk lies in funding markets and sovereign debt confidence. If equity markets drop 20%, it's painful. If sovereign bond market sees up, it's systemic, because those bonds are collateral beneath everything else. Here's the irony. The very assets considered safest, government bonds, are also the foundation of global leverage. The more debt governments issue, the more collateral exists for the financial system. In a strange way, higher public debt has expanded the system's capacity to create private credit, but it also ties stability to perpetual borrowing. The machine requires fresh debt issuance to function smoothly. Pause at issuance or question its safety, and parts of the system tighten. Now zoom out further. Globalization means supply chains span continents. Corporations operate across currencies. Financial contracts link counterparties who may never meet. A pension fund in Canada might indirectly rely on mortgage payments in Texas, funded through a bond held in London, financed via repo in New York. It's all connected. Connection increases efficiency. It also increases contagion. In tightly connected systems, shocks travel fast. This doesn't mean collapse is inevitable. It means resilience depends on active maintenance, liquidity injections, regulatory adjustments, emergency facilities. The system is not self-stabilizing. It's actively managed. Some call this modern monetary engineering. Others call it permanent intervention. Either way, it reveals something crucial. The global economy isn't held together by gold reserves or vaults of cash. It's held together by rolling short-term funding, confidence in sovereign debt, and the expectation that central banks will step in when stress appears. That expectation itself is part of the structure. If markets believe intervention will come, panic is dampened. But if inflation limits central banks' ability to intervene aggressively, or if political pressures constrain them, that expectation weakens. And expectations are everything in finance. So where does this leave us? We have a global system dependent on continuous debt issuance, stable sovereign bond markets, functional short-term funding markets, and credible central bank backstops. So far it has worked, through crises, through pandemics, through rate shocks. But each intervention adds layers. More debt, more complexity, more reliance on coordinated policy. The structure resembles a suspension bridge in constant motion, flexible, adaptive, impressive, but dependent on tension being perfectly balanced. Too much strain on one cable, and adjustments must happen elsewhere. For now, cargo ships still dock, ATMs still dispense cash, salaries still arrive on schedule. The system holds. But it holds because millions of participants, banks, governments, corporations, investors, wake up each morning and choose to trust that everyone else will honor their promises. 3 days. That's how long the illusion of permanence lasts without that trust. The fragile system isn't about money running out. It's about confidence running thin.